Hello and welcome to the monthly recap. This is for the month ending today, February 27th, 2026. Obviously, the last day of the month is tomorrow, but markets will be closed on Saturday. Got a packed house with me, packed being the key word. I got Finn, got Sadie, and then we got little Archie here as well. So, yeah, let's see how well they behave. Might have to re record this one a few times. We'll give it the old college try. Alrighty. This was a very busy month. Lots to get into. Let's get right into it. So it's Valentine's Day, President's Day, Groundhog Day. Love that freaking movie. I quote that movie all the time. Don't drive angry. Don't drive angry. So February in review. There was a government shutdown. No, it didn't even really register with most of us, but we'll talk about that briefly. Supreme Court had a pretty significant decision that could impact a lot of things going forward. Inflation came in warm, but there's some good news potentially there as well. There's definitely a silver line, which I'm going to talk about. Labor market is still showing some weakness. A little bit of probably bad information from BLS. I'll talk about that, but labor market is still showing some weakness. And mortgage rates ended the month around 5.99%. It's interesting because the headlines all over the place. New York Times, Wall Street Journal, our rates are the lowest level in 4 years. Yeah, kind of. We hit the same level of mortgage rates, and you can go back and look at some of my weekly updates. We hit the same level on rates multiple times this year. So it's not like we hit like some crazy low rate. I think partly it's the fact that it was probably a little bit of a slower news week, and in slower news weeks, they're going to start to dive a little bit deeper in some of these finer economic points. I also think part of it is simply the fact that the media is finally catching up. Media does not do a great job of reporting on rates in real time. They receive rates on a weekly basis. The information tends to be slower to come out and a little bit dated. So I think part of it's that too. Let's talk really fast about that short government shutdown. So as I said, it was very brief. It lasted all of 3 days, which especially is short when you consider we just had the longest one on record from October 1st through November 12th. 43 days. That was the longest one on record. And literally it just happened a couple months ago. Since it was so short, the impact was pretty insignificant. It's not to say that there was no disruption. There certainly was, even with some of the reporting from the government themselves. Some of those reports were delayed, but it was shorter and therefore more minor as well. This is going to be a recurring theme, unfortunately. The budget has been weaponized, for lack of a better term, right? By one party or the other, and it goes both ways. But it's certainly been weaponized, and it's been constantly an issue. It's going to constantly be an issue. The parties are certainly further away than they have been in quite some time. No reason to think that's going to change overnight. So I think we're going to continue to see this time and time again going forward, unfortunately. I want to spend more time talking about the Supreme Court decision. This one kind of flew under the radar a little bit. But the Supreme Court ruled 6-3, so pretty significant margin, that the president does not have the authority to pass wide sweeping tariffs. Okay, there was a lot of back and forth about whether or not there was precedent, whether or not the president previously had done this before, and whether or not that was even considered precedent. There's also a lot of talk about what is considered an economic emergency, because a lot of what was enacted was under this economic emergency. If you recall, some of the initial tariffs that were implemented had to do with drugs being smuggled over a border. And that's how they said, hey, this is an emergency. And then they pinned a lot of it on that. Well, the Supreme Court came out and said 6-3. Yeah, no, the president does not have the authority to do this. This really needs to happen with congressional approval going forward. Now, you know me, I try to remain as apolitical as I can, to the extent that occasionally somebody will approach me afterwards and be like, are you really this party? Are you really this party? The fact that I get that from both sides tells me that I'm doing a wonderful job of threading that needle and staying in the middle as best I possibly can. I have a lot of personal political opinions, but that's not the avenue. This is not the platform for this. I just want to give you the facts. So here's the facts, okay? Number one, tariffs are inflationary in nature. By their very definition, tariffs are inflationary in nature. Tariffs are meant to be inflationary in nature. The whole idea is, hey, we're going to increase the cost of goods that are coming from overseas, therefore making goods that are built domestically more affordable, and therefore having U.S. companies be able to take advantage of U.S. money. That's the whole kind of principle of all this. Bring the jobs back in-house because it's becoming cost prohibitive to outsource them. That's the whole kind of logic and reasoning behind this. So tariffs by their very nature are indeed inflationary. Okay, that's the one fact. Second fact, inflation causes mortgage rates to rise. Okay, a mortgage is a bond. It is a promise to pay. I promise to pay this much money for this length of time at this interest rate. Okay, lenders then bundle those up, sell them on the secondary market. Okay, mortgage is a type of bond. Okay, and since they offer a fixed rate of return, if rates are at 5.99, right, they offer that fixed rate of return of 5.99%. Well, inflation eats into that, like Archie is literally eating my fingers. They eat into that fixed rate of return that they are offering. Okay, well, that's why inflation is the arch nemesis of bonds and the arch nemesis of mortgages. So inflation causes mortgage rates to increase. As inflation comes down, mortgage rates come down as well. Second fact. Third fact, the Fed has been hesitant to cut rates due to stubborn inflation. Okay, they have a dual mandate. Their job is to keep prices under control, i.e., stay on top of inflation, and two, maximize employment. Okay, make sure that the most amount of people are employed that possibly can be employed. Okay, those are simply the facts. So, if tariffs are no longer at the president's disposal without congressional approval, it could certainly impact mortgage rates. Now, what happened immediately after this? The administration immediately came out. They wasted no time. They came out immediately and said, we have other tools at our disposal. We don't have to rely on just tariffs. We have other tools at their disposal. They didn't really show their hand and tell us what all those tools are, but they did come out and say that very quickly. They also said, hey, we also have other ways to implement tariffs, okay? To which, almost immediately, they implemented a 10% tariff, and then they actually increased it to 15%. And they did that, they can do that for up to 150 days without requiring congressional approval for an extension, okay? So they imposed global tariffs at 15%, just like that. Pretty wild. Now that's only got 150 days on it. So this is going to come to a head. It's going to come to a head sooner than we all think it's going to. We're already done with the second month of the year. It's going to come to a head fairly quickly. So be on the lookout for that. This is not the last we've heard of this. This is going to come up time and time again. As I mentioned, the Fed has a dual mandate. Maintain price control, keep inflation under control, and maximize employment. To which we have doves and we have hawks. Okay, the doves are more fiscally accommodative. The hawks are more fiscally restrictive. Doves are more in favor of rate cuts. Hawks are more in favor of keeping the rates the same or increasing rates. Doves are more concerned about the employment market, the labor market. Okay, they're less concerned about inflation, more concerned about the labor market. Hawks, on the other hand, are more concerned about inflation, less concerned about the labor market. Let's take a look at how that dual mandate, inflation and labor market, is actually performing so far. Starting with inflation. So we receive three metrics, always the case. Consumer price index, consumer level inflation as us feel it. Producer price index, inflation as businesses feel it. And then personal consumption expenditures. That is still inflation as consumers feel it. It's just a different metric that they use. And it is the Fed's favorite metric. Okay, if the Fed had their choice, they would say PCE is the most important, consumer price index, CPI is the second most important, and producer price index is in third place. We care less about that one. CPI actually had a really great month. So for January, the headline, which is all in inflation, that increased 0.17%, which is a very mild number. The yearly dropped from 2.7 to 2.4%. That's a huge decrease. 2.7 to 2.4% is a huge decrease. The more important figure is the core rate, which is when you remove volatile food and energy from that equation. What does inflation actually look like? Okay, that decreased less significantly from 2.6 to 2.5%. The Fed wants core CPI. They want that 2.5% figure to get down to 2%. That is their goal. That is their target. That's what they want. Okay. Turning our attention to PPI, producer price index, business level inflation. We got that literally today, Friday. Okay, it was not great. It came in up 0.5%. The yearly figure did decrease to 2.9% from 3%, very mild decrease. But that 0.5% increase was pretty rough for January. The core increased even worse. That increased from 3.3 to 3.6%. Now, the market's reaction today was basically nothing. Okay? They said, we don't really care about PPI. We don't really care about business level inflation because businesses don't have to pass that along to the consumer. And as we've seen lately, they have not been passing along all that increase in cost of goods to the consumer. Now, maybe over time they will. but so far they have not. And it's been a trend over the last year as well, where we see, kind of high elevated PPI numbers, but it doesn't necessarily translate into CPI. So the markets kind of shook it off and said, whatever, it's not a big deal. PCE, personal consumption expenditures, the Fed's favorite measure. Headline and core both increased 0.4%. That stung. That was a really rough number to see. 0.4% increase. That was not great. Headline jumped from 2.8 to 2.9%. The core rate jumped from 2.8 to 3%. Again, they want that core PCE to get from 3% down to 2%. So we do have a lot more room to go before we get to the Fed's target on their favorite inflation metric. I mentioned a silver lining here. What is the silver lining? Well, whenever we look at a yearly number, okay, we look at the numbers from a year ago, the numbers that are being added today, and a number from a year ago will fall off that report, right? They look at 12 months, okay? That's year over year number. They look at the last 12 months. Well, when we look at the upcoming months, 2 out of the next 3 months, the numbers that are going to be falling off from a year ago are very, very hot numbers. So if we get even a tame, mild number, we should start to see some meaningful progress being made on PCE. I've actually been talking about that for like 6 months now. So we're almost there. Starting next month, we should start to see some meaningful progress being made on personal consumption expenditures. Fingers crossed, so long as we get a mild reading, we should start to make some progress. Again, out of the next 3 months, we really have 2 really hot readings that we'll be replacing. So fingers crossed there. Let's talk about the other half of their dual mandate, which is the labor market. BLS, Bureau of Labor Statistics, okay? That's what the government relies on for their unemployment rate. That's what the government relies on more than anything else when it comes to labor market. And they shouldn't, because those numbers are really, really undependable, okay? We've seen significant numbers, and then we see them take a machete to them, and they cut them in half when they do their revisions. We've seen some pretty significant revisions. They came out with a blockbuster number for January, 130,000 job gains. That's a shocking figure. The markets were only expecting about 70,000, so almost double what was expected is actually what happened. Now, I mentioned at the outset that the labor market still shows signs of weakness because I, along with many other people, do not put a lot of weight or credence into the BLS numbers. They do a lot of modeling. A lot of what they do is they try to figure out how many businesses were born and how many businesses died, and from there, how many jobs were added. It's a lot of modeling. It's a very small sample size of people that they then extrapolate, what they call the household survey. They take a very small sample and then they extrapolate it across the entire country. It's very unreliable, as we've seen time and time again. The November and December numbers were revised lower by 17,000. That's actually a pretty mild revision downward. Now, here's where you can kind of run the tape and quote me on this. I think we're going to see a significant revision of the January number, okay? And I think we are going to show, again, as we have previously, time and time again, that the BLS numbers are just unreliable. You can quote me on that. We'll see what happens next month when they start revising those numbers, but I think we're going to see some pretty significant revisions. ADP, more reliable, significantly less revisions. They only showed 22,000 job gains in January. So, Aaron, where are you getting this? Well, ADP is a much more reliable source, and they showed a very small, anemic, kind of, again, weak labor market as a whole. Revelio is another pretty reliable employment data resource. They showed 13,300 job losses in January. So if you have Revelio and the ADP both saying, hey, things don't look great, and then BLS come in with these blockbuster numbers, then they have a history of revising those numbers drastically. Which one are you going to put more weight into? I think ADP and Revelio are a little bit more reliable. Quote me. Let's see what happens next month. If I'm wrong, I will eat crow. But yeah, we'll see. All right. Let's start talking about next month. We've got our first significant Fed meeting of the year. Now, as you can see, this is the Fed meeting schedule, right? Of these meetings, there's 4 bigger meetings, okay? March 18th is the first one. So the ones that are in bold with an asterisk, those are meetings associated with a summary of economic projection. It's where the Fed doesn't just make their rate decision, but then they show their work. Hey, here's where we think GDP is going to go. Here's where we think unemployment is going to go. We have to talk about the Fed funds rate. Where do we think, how many more rate cuts are on the horizon? They basically have to show their work. Well, March 18th is our first big meeting of the year. It's also going to be an opportunity for the Fed to cut rates if they want to. I will say that the Fed does prefer to make their Fed rate decisions at the larger 4 meetings of the year. Okay, that doesn't necessarily mean we're going to get a cut next month, but they do prefer to make rate decisions at those larger meetings because it gives them a platform to show their work and explain their logic and reasoning a little bit more than those abbreviated meetings. Okay, so we shall see. Now, what's going to happen next month? Well, all eyes are going to be on inflation and labor market again. We should start to see some meaningful progress on inflation. Fingers crossed. Labor market is it still coming in weak? Again, quote me. Let's see how significant the revisions are to those January BLS numbers. Big Fed meeting, as I just mentioned as well. And then what really comes of the tariff ruling? 150 days. 150 days before it requires congressional approval for an extension. So expect to hear a lot more of this. Okay, this is going to come up time and time again. What's actually going to happen? There's actually been some talk about other countries possibly seeking some of the tariff money back because it was unlawful, according to the Supreme Court. Going to be very interesting. Do not expect that this is the last year you'll hear of this. You're going to hear about this, unfortunately, a little bit more. And then what surprises did March have in store? Good grief. We had a government shutdown last month. This month it doesn't feel like it, but we did. We had the Supreme Court ruling, which is going to have huge ramifications. One month it's Venezuela, next month it's eyes on Iran and Cuba. Like, oh my gosh, like what's going on? There's going to be inevitably some surprises in March. Strap in. There's surprises every month. And I think that's it. I hope you all had a wonderful month. I hope you all have a wonderful month ahead. If you need anything at all from me, please let me know. Thank you all so much for all the referrals and the support. It is the lifeblood of my business. My team and I, we cannot live without it. So thank you all very, 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 very much. We never take it for granted. And I think that is it. Archie, you actually did pretty well, buddy. Yeah, appreciate you. And thank you, Finn. Thank you, Sadie. See you guys next time. All right. Bye.